Economic crises have repeatedly tested the resilience of financial systems and societies worldwide. They bring uncertainty, fear, and disruption, shaking investor confidence and causing waves that ripple through economies at every level. In the midst of such turbulence, gold has traditionally been viewed as a bastion of safety, a haven asset that holds value even when everything else seems to falter. But what really happens to the price of gold when another economic crisis strikes? To fully understand this, we need to explore the multifaceted relationship between gold, economic turmoil, monetary policy, market psychology, and global finance. Gold's allure stretches back thousands of years. Unlike paper money, which is essentially a promise by governments, gold is a physical commodity with intrinsic value recognized by cultures across the globe. Its scarcity, durability, and beauty have made it a symbol of wealth and power since ancient times. Historically, many economies linked their currencies to gold under the gold standard, allowing holders of paper currency to exchange it for a fixed amount of gold. While the gold standard was largely abandoned during the 20th century, the symbolic and practical role of gold as a store of value and safe haven remains deeply ingrained. When an economic crisis hits, confidence in financial markets and fiat currencies often declines. Investors facing uncertainty seek assets that can preserve purchasing power and provide security. Gold, by virtue of its tangible nature and long-standing reputation, becomes an attractive option. The price of gold typically rises as demand increases, reflecting a flight to safety. This phenomenon is rooted in several economic and psychological factors. One critical driver of gold's price during crises is the anticipation or reality of inflation. Economic downturns often prompt central banks to inject liquidity into the system by cutting interest rates or engaging in quantitative easing, effectively increasing the money supply. While these actions aim to stimulate growth, they can also raise concerns about future inflation, which erodes the purchasing power of paper money. Since gold is seen as an inflation hedge, investors flock to it when inflation fears mount, pushing its price higher. Currency fluctuations further complicate the picture. Gold is priced internationally in US dollars, making its price sensitive to the strength or weakness of the dollar. During crises, if the dollar weakens due to loose monetary policy or loss of confidence, gold becomes cheaper for holders of other currencies, boosting demand. Conversely, a strong dollar can put downward pressure on gold prices. However, the relationship is nuanced. Gold itself is also perceived as a currency substitute during turmoil. Interest rates also play a significant role. Gold does not generate yield or dividends. When real interest rates, nominal rates adjusted for inflation, are low or negative, holding gold becomes more attractive compared to bonds or savings accounts. Economic crises often lead central banks to slash interest rates, creating a favorable environment for gold prices to rise. Looking at historical precedents provides valuable insight. During the Great Depression of the 1930s, although gold prices were fixed by the US government, gold remained a symbol of stability amid widespread financial collapse. The government eventually raised the price of gold to incentivize hoarding and help stabilize the economy, underscoring gold's strategic importance. The stagflation era of the 1970s offers a clearer demonstration of gold's price dynamics during economic stress. With stagnant growth coupled with soaring inflation, the US dollar lost purchasing power rapidly. Investors rushed to gold as a hedge, driving prices from around $35 an ounce in 1971 to nearly $850 by 1980. This dramatic surge reflected the panic and uncertainty prevalent in global markets. The global financial crisis of 2008 serves as a more recent example. As Lehman Brothers collapsed and credit markets froze, equity prices plummeted and fears of systemic failure grew. Gold initially dipped briefly as investors sold assets to cover losses but soon recovered and soared, reaching record highs over $1,900 per ounce by 2011. This rally was fueled by a combination of safe haven demand, low real interest rates, and unprecedented monetary stimulus. Similarly, during the COVID-19 pandemic, gold experienced a significant surge. The massive economic shutdowns, record fiscal stimulus, and uncertainty about the future economy created ideal conditions for gold to shine. It broke through the $2,000 per ounce barrier, reflecting investors' desire to preserve wealth in an unpredictable environment. However, the behavior of gold during crises is not always straightforward. Market psychology is complex, and short-term reactions can defy expectations. Sometimes, during the initial phases of a crisis, investors sell gold holdings to raise cash, causing a temporary dip in prices. When the dust settles and panic intensifies, gold demand typically rebounds. Furthermore, gold competes with other safe assets such as government bonds, the US dollar itself, or even newer alternatives like cryptocurrencies, each influencing gold's price trajectory. Another layer to consider is the role of central banks. These institutions are among the largest holders and buyers of gold reserves. In recent years, many central banks, especially in emerging economies, have increased their gold holdings as part of diversification strategies to reduce reliance on the US dollar and strengthen financial security. During crises, central banks may intervene in gold markets directly or indirectly, affecting supply and demand dynamics. Mining supply is also a factor that impacts gold prices. Gold mining is capital-intensive and takes years from exploration to production. The supply side cannot quickly adjust to sudden changes in demand, making gold prices susceptible to supply constraints. Political instability in mining regions, labor disputes, or environmental regulations can further influence production levels. In the event of a new economic crisis, the interplay of these factors will shape gold's price movements. The specific causes and characteristics of the crisis matter significantly. For example, a debt crisis in a major economy, a banking collapse, geopolitical conflict, or a pandemic. Induced recession each affects investor behavior differently. If the crisis leads to aggressive monetary easing and soaring inflation expectations, gold prices could skyrocket. On the other hand, if confidence shifts quickly back to risk assets or the dollar strengthens due to a flight to safety currency effect, gold prices may temporarily soften. Moreover, regulatory responses, such as restrictions on gold trading or shifts in reserve policies, could influence markets. Technology and market structure have evolved since previous crises. The rise of electronic trading, ETFs, and algorithmic trading has increased gold market liquidity but also introduced new volatility dynamics. For instance, ETF flows can amplify price swings as investors move in and out quickly. Retail investor participation via apps and online platforms has also grown, making gold prices more sensitive to sentiment. Looking to the future, emerging trends could further affect gold's crisis behavior. The growing interest in digital currencies, especially central bank digital currencies, CBDCs, might alter the demand for physical gold as a currency alternative. However, digital assets currently lack gold's historical trust and intrinsic value, suggesting gold's role as a hedge will endure for the foreseeable future. Environmental and social factors are also coming into focus. Responsible sourcing of gold, sustainable mining practices, and concerns about conflict minerals are influencing consumer and institutional preferences. This might affect supply and cost structures, thereby impacting prices during times of crisis. For individual investors, understanding these complexities is vital. Gold can play a strategic role in diversifying portfolios and protecting wealth during downturns. However, timing, allocation, and the form of gold ownership, whether physical bullion, coins, ETFs, or mining stocks, can affect outcomes. Gold should be viewed as part of a broader risk management strategy rather than a guaranteed profit vehicle. In conclusion, gold's relationship with economic crises is multifaceted and influenced by a web of interconnected factors. Its status as a safe haven stems from its unique properties and long-standing cultural significance. Historical evidence shows that gold often appreciates during economic turmoil, driven by inflation fears, currency depreciation, low interest rates, and investor psychology. Nonetheless, gold's price behavior is not guaranteed and can be volatile in the short term. The nature of the crisis, monetary policy responses, central bank actions, supply constraints, and evolving financial market structures all contribute to price fluctuations. As the global economy faces growing uncertainties, from rising debt burdens and geopolitical tensions to climate change and technological disruption, Gold's role as a stabilizing asset remains relevant. Investors, policymakers, and analysts will continue to watch gold closely as both a barometer of fear and a beacon of security. Ultimately, gold's shimmering legacy as a refuge in turbulent times underscores the enduring quest for stability and trust in a world of economic unpredictability. The price of gold in the next crisis will reflect not only market fundamentals but the collective hopes and fears of investors seeking safety amid the storm.